Simon, welcome for a post-election monthly update. Finally behind us. I want to say the uncertainty and everything, but it's politics, so we still had some drama and things happening and people saying things about nationalization, and then other people going, no, that's not the plan, and we're all very confused. But we're not going to focus on that today.
Because it's finished and we're glad it's over.
Yes, we are. We might look at GDP contraction a bit later, but I think the big story for me in the market, outside of Tongaat, but we also get into that because nobody knows what's going on. Old Mutual, CEO, just up and left, surprise. I mean, him and one of many other CEOs who are just like, yeah, I'm done. Thank you very much. But this is the second in the NBFI space. This is the second CEO to sort of leave or be kicked out, however you want to look at it, without much explanation, without much warning. I mean, we saw this with Andrew Dufour, Alexander Forbes. Mm-hmm. What's going on?
So we're seeing a lot of CEOs suddenly say, I've had enough, and Massmart, etc. And it's tough out there. It absolutely is. But it raises a couple of points. And to your point, typically nothing is said. Andrew Dufour, nothing was said. At the Massmart, nothing was said.
There's no warning signs. It's not like something went wrong. It's just, there's what are these differences?
And I think boards, companies owe it to shareholders to be a little more frank. And with the Peter Moyer Old Mutual story, we got a little bit of a glimpse of an insight, and they talk about conflict of interest. Now, the backstory is that he had a asset management firm who did a lot of work with Old Mutual. This was no secret to anyone when he was appointed in 2017.
But suddenly...
And obviously, and both parties have claimed, Trevor Manuel, the chair of Old Mutual, mentioned it at the AGM Friday before last, where he's like, there was processes and they haven't worked. Now, to my mind, this is a failure both on behalf of Peter Moyer and on behalf of the board.
The board, yes.
They went in knowing what it was. They put something in place to manage it, and it simply hasn't worked. And my question is, so what did they put in place? Why not just a complete and absolute blind trust? And maybe that was it. But again, they leave shareholders saying, well, hang on, okay, so there's some culpability with Peter Moyer, but he's now ex-CEO, suspended and etc. But there's real culpability sitting at board level, which says whatever structure you put in place just wasn't sufficient. And I appreciate, look, things break down. You have the best intentions in the world and things go wrong. But at a giant company like such as Old Mutual, really it should have been able to have been handled significantly better. And Trevor Manuel made it very clear at the AGM where he said, there's no impropriety or anything, it's not working. But 2 years in, and CEO of any large company, your first 2 years, you kind of only just discovered where the toilets are and how to order tea and coffee.
Yes, but I suppose even with the Old Mutual case, it's first of all new company, but second, there's a whole new structure within the company. So it's not even that you're taking over a company, you're taking over a company that's also just started a completely new journey.
Yeah, because it's the whole managed separation, which is their talk for returning back from the UK. In 1999, they went off to the UK, and now they've come back. And for that 20-year period, we never were sure, and truthfully, neither was Old Mutual, whether they were an emerging market or an EM or a
what's going on.
And now they've got a very clear strategy, and I like the clear strategy, which is they've come back to South Africa, they're going to focus on South Africa. It's a very tough space right now. We see it with Momentum, with Liberty, with everybody else. But nice clear strategy. I thought a really good CEO in place. And now it's all out the window, and they're CEO-less. And somebody now has to come back in and discover where the bathrooms are. And I suppose, if we want to quickly look at it from the other side, is if there is a problem, rather nix it in the bud and part company, rather than try and paper over cracks. I appreciate that. I think that the problem shouldn't have been able to arise. It shouldn't have been allowed to get.
It shouldn't have gotten to those points in the first place.
Yeah,
because the T's should have been crossed and the I's should have been dotted, and we shouldn't.
And there should have been oodles of goodwill on both sides. And we come to the point which you made right up front, which is we're sitting here having to speculate wildly, and that's a really bad position to be in. far too often, yesterday, and it's Pembury, so it's not a stock that anyone cares about, CFO leaves. Okay, so CFO suddenly ups and leaves. Give us some background to it. Now, it's not that we want the dirt because we're voyeuristic, and truthfully, we are.
I mean, we would
do.
love the dirt.
No, I mean, but if I were a shareholder, it's like, whoa, hang on, my CFO just quit with no notice. What's going on? Why? Is it because and usually it's either family interests or to pursue new interests. But there's a reason, and that reason is oftentimes potentially significant to shareholders. And as shareholders, we're kept in the dark. And I think it is a lax corporate culture. It's not unique to our culture at all. It happens globally. But I think boards beholden to shareholders. And also, there's a glimmer that shareholders are perhaps getting a little more feisty. Old Mutual, AGM, vote down of the remuneration policy and the implementation thereof. In part, Peter Moore earned 15 million for the managed separation, which, with respect, I thought Bruce Hempel was doing it. Peter Moyer came in quite late to that process. And we're seeing shareholders a little bit carefully, and remuneration votes are non-binding, but we're starting to see them stand up and stamp their feet sometimes. Yeah,
this isn't okay.
And I think it's a good thing. I think it's partly a symptom of a zero return market, but I think it is also just a consciousness that is starting to come from shareholders. 20 years ago, who cared as long as you sent me dividends? I think shareholders are starting to get a little more feisty. And I think they're going to get a lot more feisty in the decades ahead.
Yeah. And, okay, so on succession planning and all of this stuff that's been going on, Absa is without a CEO.
Yeah.
And, I mean, the reasons behind it are, some of the candidates that they're looking at. There are obviously Reserve Bank restrictions and so on and so forth. So there's a long process when it comes to choosing the CEO of a bank, which is all good and well. But I just have one question. Why didn't they start the process way before Maria was leaving? Because it's not like, Maria woke up and she was like, tomorrow I am retiring. You've known this was happening. So why the delay? And also, what do you think the impact will be on their strategy? So now we're sort of, Absa's flying rudderless a bit. There's no CEO. There's an acting CEO, but his powers are very limited in terms of continuity about with strategy implementation. And it's a very tough environment. So to be without a CEO and to be without a solid strategy is sort of a very big gamble.
So, and some of this delay might be Saab because they need to approve and stuff, but that's no excuse. Maria Ramos, at least 3 years ago, was indicating she wanted to, and then
that process should have started.
Yeah, and then there was divorce with Barclays, and she was asked to stay. Fair enough, but that no CEO. I mean, the short answer is no CEO stays forever. And then Warren Buffett springs to mind. But as a rule, no CEO. David Iger, as a rule, that they're leaving. And so this smacks of two things, which is, as you say, no strategy replacement, internal or external. And that's the issue. Most often, it's an internal process, and you identify those candidates well in advance. You almost get to a point where you appoint this CEO, and you know who will replace them in 5 or 10 years in an ideal world. And lots can go wrong, but you've got long lead succession times and the like. And seemingly nothing here. And then comes to the crux of the problem. With the separation from Barclays, new strategy they've got to implement into Africa, new branding into Africa, because in South Africa we never really knew Absa as Barclays, so that's neither here nor there.
That's fine. But
the rest of the continent, it's known as Barclays. They've got to change to Absa. Someone in Kenya or Ghana is like, who? They don't, and also their local strategy, which, as much as Maria Ramos denies it, was to some degrees hindered by the Barclays ownership. They certainly pulled back on lending. They've lost market share. This is a exceedingly tough environment, always, for big banks in South Africa. More so when you're muddling along at pretty much zero growth and the like. And
because that's where we are.
Yeah, and we've commented before, the banks doing low single-digit HEPS growth in this environment is actually not bad. But, the Absa needs to come back fighting, and they can't do that until they have a permanent CEO. And that permanent CEO then needs to sit down and review strategies and strategize and plan, which puts them behind the curve versus Nedbank, FNB, Standard Bank, Capitec coming with Mercantile, so now they've got some business banking on the side. It does put them behind the curve. And it is, again, culpability falls to the board. to your point, when was Maria Ramos leaving? Maybe we didn't know, but what we did know, she was leaving one day.
Definitely going to leave.
She was leaving one day. She wasn't staying forever in a day, and it's a black mark. There has perhaps part of the trick has been an exodus of sorts of senior execs at Absa over the last year or so, and maybe one of those was appointed. But again, it's still a process that should have been markedly better managed. And if you look at the Absa valuations, banks generally in South Africa are trading on cheap valuations. Absa, by a way, on the cheapest valuation.
Yeah, out of the four.
Yeah, five. However many big banks you want to pick.
Okay, and perhaps let's also just touch on Capitec, because I think that's quite an interesting journey that they're embarking on, going into business banking. And, I suppose not really surprising. I know back when I was a journalist and one lifetime ago, we'd sort of speculated about Capitec venturing into the business world, and we're seeing it materialize now. Do you think the other banks should be concerned? I mean, they've done really well in the retail space, and we can see sort of like people, they have birthed price wars, which we'll touch on. But now we're going into the banking space, and that's a very tough space, because all banks, as we know, very conservative. If you speak to any small business owner and you tell them how difficult it is to try and get any form of funding from the banks, it's just impossible. Is Capitec going to plug that hole like they've pretty much plugged the lower income loan hole?
It's going to be difficult. It's different to lend to an individual than it is to an SME. Yes. SMEs have a much higher failure rate than individuals. SMEs have very different requirements from individuals, but they have bought Mercantile Bank, who were in the space and are fairly well regarded. They paid up for it, but they didn't pay too badly for it, but it gives them a nice base. And they've got obviously a lot of lessons over 20 years of Capitec, starting as a microlender, moving into banking, and now, and you can see, they do home loans, but they do it with SA Home Loan, and they do some credit cards, and they do vehicle finance, but to them that's just a loan with an unsecured asset, because you can drive the car off into the sunset. And that there will be some lessons from that, but I like how they've done their rollout, and I certainly, in the short term, it's going to be a long time bedding down. It's going to be a process, but I wouldn't be surprised if for 10 or 20 years we were talking about, and Capitec was now a major player in the space.
Yes.
And it's partly, again, how they've done it. When they came at the big banks, they went at a part of the market which the large banks, back then the big four, didn't really care about, and that was the low cost, the small accounts, the poorer section of the population. And now they're edging their way up, and they're going to do it in the same in banking. They're not going to try and get Barlow World's bank account. That's not what they want. They want Simon's little SME bank account. That's what they're trying to get their hands on. And it's going to be a significant challenge for them, but if anyone can do it, Capitec probably can. And if you've listened to the executives talking around the acquisition and how they plan to do it, certainly my sense is that they've got a clear idea. They're going to take it very gently, very slowly, and I think in the short term, no worries. In the medium to longer term, they could certainly become a significant player in the space. And we talk about four big banks. I mean, truthfully, these days, it is five, and Capitec is there.
We can't ignore the Capitec effect.
We
we
absolutely can't.
Okay, moving on to retailers and focusing specifically on Mr. Price. Recent update, trading update, revenue up 5.8%, HEPS up 6.2%, which is pretty good under the conditions. But, I'm quite liking that, they dipped their toe, unlike others, dipped their toe in Australia, realized it didn't work for them, and then decided to not dip toe. And now looking for new opportunities. And I guess my question is, amid, and we're going to talk about this later, trade wars. Amid this trade war scenario and low growth environment, maybe apart from sort of like the US, but again, trade wars, so we don't actually know what's going on there. But if you're thinking Europe, other emerging markets, everything is just sort of at a go slow. There's lots of external global pressure. Are there actually, what is the value in expanding globally, and where do you go if you can't go to Europe?
We know what the value is. The value is negative. On big acquisitions, on big expansion projects, big mergers, quantifiably 2/3 of them fail.
We've seen just a succession of just failure after failure after failure.
And these stats are not even, they're global stats, and in South Africa it seems like it's more than 2/3. And I can see what happens, right? You're sitting in your boardroom, you're doing great locally, you're king of the world, and you think, let's go take over Market X. The trick is you're king of your little world, and Market X is fundamentally different. So then the question is, well, should you at all? And the answer is, well, how about doing it small, rather than the David Jones, rather than the Lake Charles, rather than the gourmet burger kitchen, etc., etc. And we've seen companies who've done it sort of bit by bit, and then suddenly one day it's like, whoa, they've actually got a decent presence in that market. And that's what Mr. Price tried, and I much prefer that. It's less glorious, it's harder work, it's a long time before it becomes significant.
But the impact is
ShopRite, 20% of their revenues beyond the South African borders. It's been a 20-plus year journey. They could have just gone and bought someone 20 years ago and probably failed in the process. What I then like is, so do it slowly, and then if it doesn't work, get the heck out in a hurry. And we've seen Discovery tried America. It cost them R1 billion, back when R1 billion was a big number. This is early 2000s. But at least get to the point where you say, and get there quite quickly, where you say, it isn't working.
Fail fast.
We've spent the money, we're not going to spend anymore. It's been real, cheers, let's move on. And kudos to Mr. Price for doing that. I mean, their results indicate a very tough environment. If you strip out stock increases and inflation, they're slightly negative, but they certainly are top retailer, and I like the idea that they tried, failed, fail fast.
Yeah. Okay, and the big deal, I suppose, of the year, Sibanye and Lonmin. Finally, shareholders approved. Comcom has implemented a few restrictions, but it seems we're getting our big PGM giant.
It's weird because, of course, Sibanye came as the gold assets that no one wanted locally, apart from the South Deep asset, and now they're a PGM player, and that's just Neil Frontman just pivoting absolutely. Stillwater in Northern America, and now couple of assets. This makes him, as you say, the largest PGM player. He's got, assuming the deal goes, and it looks like it will, and the market is liking, a couple of issues, a lot of debt in the balance sheet, thanks to Lonmin, because this is a share deal.
And we're going to talk about Lonmin a bit.
The bigger issue is that he's price taker, and palladium's in a really good place, and there's one of three scenarios. One is palladium stays high and rhodium and platinum stays depressed, and that will be fine for them. The other is that palladium and rhodium come down and platinum doesn't respond, and that's really bad for them. But what if platinum rises? What if platinum, and I'm not talking 16, 1800, what if platinum goes to 1,000 or 1,100 or 1,200? Suddenly, we've got a little ATM. In fact, we've got a large ATM here. Now, I don't play single commodity stocks. I don't like them. But if you're seeing platinum starting to move, this is a really, really good play to be in, because then suddenly his debt becomes easy to pay off. The profits just absolutely flow, and they just start printing cash at a massive rate. So risks, but you can see the rewards at the same time. At this point, I would be neutral. I wouldn't be looking for a position, but I like to, when the underlying commodity starts to move, find the best leveraged single commodity player, and it's probably going to be the Sibanye-Lonmin merger, and they're going to just throw cash like there's no tomorrow. We need platinum to move, and I don't know what's going to drive that, because platinum's done nothing in forever
in a while.
Yes.
In a very long while. Okay, and then of course there's concerns about job losses. 12,600 Lonmin, 890 Sibanye. So collectively a very big number, but Comcom has put, if the deal goes through, they cannot fire anyone for 6 months or let anyone go. They don't fire them, they retrench them.
Yeah, section 158 to 152s.
So, I mean, this is obviously, job losses never go without consequence, and in a big deal like this, it makes sense from the shareholder value creation type of thing. But could this kick off a strike just before we get what we want? Would the unions sort of be like, whoa, we can't do this? Would they fight the deal?
So probably they would. They don't like job losses. No one likes job losses, let's be honest about that. And the number in total is small, but it's not small. It's a lot of lives out there and families and all the ripple effects there. The trick with the unions is that, I mean, ARMCU is in trouble. They're really, really struggling. They've got the register of unions on their back and threatened to withdraw their status as a union. They've lost some significant battles in recent times. I think the memories of the 5-month strike when Marikana happened still lingers deep. So I think the economic environment that we find ourselves in 2019, workers are perhaps a little more shell-shocked. I think it's going to be perhaps harder to try and get a strike. And then it depends. Are the unions now going to say, well, okay, maybe a strike's not the deal. Let's just try and negotiate a better deal for workers left behind. Let's try and negotiate better retrenchment packages, retraining, first in line, these type of processes. Neil Frontman typically takes a fairly hard line with the unions, but I think in this case, perhaps he's a little more sort of keen to come to negotiating table because he wants the deal and he can see how it works. But if a strike happens, then suddenly all bets are off. I mean, in terms of the greatness of the deal, can the two parties walk that line? I think if there's been a time in the last, I was going to say 10 years, but truthfully 30 or 40 years perhaps, between mining bosses and labor in this country, this might be one of the first times when perhaps there's almost a sense of, you know, guys, like, actually we need to talk because we can't do the protracted strikes. You know what, it's sure, please, no, not another long, protracted, horrible, ugly strike. And maybe we'll get some common sense coming through.
Now, Lonmin and the K4 mine, very, very lucrative mine, potentially, you know, but, you know, needs 300 mil to 500 mil US dollars to be completed, and net cash currently, I think, at Lonmin is like, as at end March, is like 71 million US dollars. They don't have money, and they've already got a whole lot of debt on their balance sheet. That, like, how do they get around this? Will Sibanye have to give them the money?
So Sibanye, I mean, I think the work on that is progressing, but probably very slowly because they're frankly running out of money and they can see the end days. It's going to be a broader Sibanye picture. And Sibanye can perhaps fund it from internal cash flows because they've got Stillwater, they've got some gold assets, they've also picked up other bushveld assets around so they can pick up some synergies and the like. So I think the plan from Sibanye, from Neil Frontman, is very much going to be a case of we can perhaps almost fund this internally. What it might do is push out project deadlines a little bit further because you need to slow down. But at current commodity prices, gold is looking nice. Picked up a bit. Rand a little bit weaker helps them as well. Although to your point, it's dollar-based costing. But I think that they can probably do it internally, and I think this is part of the trick. Why Lonmin shareholders had to vote yes, because they were running out of money and there was no option. And while Sibanye shareholders voted yes, because that's a great asset, a really great asset. And it's often the case of a mine in one set of hands is not viable, but in another set of hands is viable for bunches of reasons around technology and how they process, but also just simply on simple things like availability of cash. Proximity of two mines. You suddenly got two mines that are close to each other when you got one owner. Now you've only got one smelter, and that is a cost saving in that essence there. So I think that'll be funded out of Sibanye's cash flows and maybe a bit of debt, but I think they can probably do it out of cash flows over the next sort of 3, 4, 5 years.
Okay, and then done with stocks. Now we move on to the lovely, beautiful trade wars, and you'll be doing a webinar on this, so we're not going to dwell too long on that because I know you'll be able to give everyone the proper rundown, etc., etc. But
I'm finding fascinating data. I love the internet. You go down rabbit holes and you find. I mean, there is. Yeah, I'm finding wonderful data.
So, you know, there's a lot, and, you know, you listen to podcasts, and there's just so much information around trade wars, the implications, etc., etc. You can't help but be a bit overwhelmed as somebody who, if you're sitting in South Africa, you're sort of going, wow, this is all very fascinating and sounds very scary, but, like, at the end of the day, how does it affect me? You know, and this is what you're going to be talking about. But I wanted to chat about what Trump has done so far. So increased tariffs to 25% on $200 billion dollars worth of goods against China. And China obviously, is starting their little retaliation strategies, but they don't really have that many options.
They don't. People are talking about rare earths, but rare earths actually aren't that rare. The Japan's got in a whole bunch of other places that would be a short-term squeeze. They've got U.S. treasuries.
But that wouldn't
work for anybody.
Them.
No.
Yeah.
So I think China's probably doing two things. One, they might let their currency just float a bit, and that could benefit them. The bigger deal, I suspect very much so, is that Trump is there for another 6 years, and
please no.
Well,
but it's likely to happen statistically.
2 to 6 years. The Chinese premier is now voted for life and takes the long-term game, and it's perhaps a case of we can outwait him, because negotiating with Trump is nigh on impossible. I mean, we saw the tweet he suddenly threw at Mexico.
Yes.
But I think China might just say we'll play the long-term game. There is a much bigger implication, and that I suspect is what the real issue is that world leaders are going to be less keen to trust other world leaders, not just Trump, but generally.
Everybody.
China's going to take the view, look, you're signed, but how do I know who's going to win your next election type of scenario? And there was always a sense of continuity regardless who was in power, and I think maybe we're seeing that go. So implications are real. At this point in time, we're recording Wednesday morning, markets moved on, right? Because Jerome Powell's going to cut rates and we are booming.
We're happy.
Best day on the S&P in 5 months. But that's the short term. This trade war has significant longer term implications, not just in the immediate China or America, but I think in the bigger picture. What China's going to start doing, of course, is saying, well, hang on a bit, we need to perhaps become a little more self-sustaining. Of course, Huawei, they did it with that. And that's going all very ugly. But then Huawei get banned because they're bad and maybe spying, and then Trump says they could be part of the trade negotiation. And then it's like, well, either
which one is it? Or I feel like at this point, Trump is sort of clutching at multiple straws and just throwing whatever. It just feels like he's just reaching into his kitchen, and whatever he grabs, he throws. And
what I do think we'll see, so if we go all the way back to the 1920s, Smoot-Hawley did some trade deal. It was supposed to be, or some tariff protection. It was supposed to be 2 items. By the time Congress was finished, it was 8,000. And Congress was so panicked by that, they gave full authority for tariffs, not trade deals, tariffs to president. And now I think they might pull that back. So I think they're going to be but that's not going to happen soon. That'll be a post-Trump
we learned
legislative.
This lesson. Therefore,
it'll pull it back to Congress. Is that good or bad? But the issues are real, and the short answer is it bad for global economy? Yeah,
absolutely.
I mean, absolutely. IMF World Bank talking at least 0.5% down, and that's on the old tariffs and before the Mexico tariffs, and who knows who comes next.
I mean, I was looking, I didn't bring them, but I think the MSCI World Index down some 6%, emerging markets down overall. So we're down in May, also down about 6%. So we've really seen some
we were. I mean, if you look at our market, we were up almost 12% at the beginning of May, and at the end of May we were up just over 6%.
And that because in May we were also down almost 5%.
And that's global markets were significantly under pressure. And a quick throw forward to the presentation. So, what is the sector that's done best in the last decade? And it's tech stocks. And if you look at Nasdaq 100 versus S&P, Nasdaq's done about 12%, S&P about 8%. Tech stocks. Look at the sectors most impacted by the trade wars, and about 14% of tech stock revenues are potentially impacted. By a long way the biggest hit. So you've got your stocks that are most expanded, most at risk. And it's not so GDP's under pressure, but when the markets remember trade wars and results start coming through, this could get ugly. This could be, and I know this sounds highly alarmist, this could be what kills our bull market. And when I say our, I mean America's.
We haven't not ours. Because we've been standing still.
We don't have a bull market. But this could be the end of the longest bull market, which had to end at some point for some reason, and maybe this is it.
I don't think we expected this to be the reason.
No, we didn't think the American president would stab it, but
he...
And then it gets interesting, of course, because then if Jerome Powell and his team are now cutting rates, then, well, okay, that should help. But then we're in the new space, now we're back to low rates. What happens when we have a significant economic crisis and we haven't got rates to cut?
And I suppose they still got a bit of space to shave off, unlike Europe, where they're in the negatives already. So
I think you hit the nail on the head there. Whereas in the olden days, and by that I mean 2 years ago, we would have talked around rates as in low.
Yes.
Now we don't talk about rates as in low, we talk about them negative. So when I'm saying the US has only got so many rate cuts to get to zero, the mistake I'm making is thinking zero is the floor.
Is the floor.
It's not the floor.
I mean, Japan's been cruising, and Europe, they've been cruising on.
And it comes to the point
Nick.
is when times are good, you want to return on your investment. When times are tougher, you want to return of your investment.
Yes.
And it might come back a little bit smaller because you had a negative rate, but it came back. And that's the point. So I think it's the mind shift we need to take. Is it possible in our lifetimes that we will see negative rates in the US? The answer is yes.
Quite possible.
And that is the craziest thing I've ever said in my life. But it's, well, no, probably not. But it is possible. I've said some crazy things. But we might see, zero is no longer the floor.
No, it's not.
And tell that to an economist from the 50s.
Yeah. I think none of us actually would have...
None of us thought about it.
Maybe... But anyone who did Ecos 101 in like the 1980s,
this was not what you were expecting.
But that was also before quantitative easing and all of these fancy schmancy economic tools that have suddenly become very mainstream. Which is quite interesting. Somebody was writing a thread about whether quantitative easing is really is it valid?
Brilliant Fred on Twitter this morning.
Yes.
I forget her name.
Bula.
That you got
Yes,
find
and I
read
was
it.
just like, that is actually quite interesting because it's only ever worked for the US.
For the US.
Yeah, because
And
Japan has been riding that
What
way.
it hasn't done is help inequality, the poor, the indebted.
No.
Truthfully, it helps the rich and those with
and
investments.
The banks, and the bigger...
Yeah. And truthfully, if you have a job, you've probably got some form of investment in terms of retirement and the like. But quantitative easing worked once. And it worked because they were quick, fast, and big. They went crazy with it. Japan was slow. Europe waited another 3 years. I mean...
They sort of took a wait-and-see approach, waiting for the US.
Whereas the US just went aggressive. QE1, QE2, and then QE kitchen sink.
Yeah.
And it worked. Except that we're still fragile. I mean, the US economy in terms of employment, in terms of GDP growth, etc., is doing brilliant, but fragile in the terms of no space to cut rates. Fragile in terms of the global economy is being driven broadly by one economy, America.
Yes.
Some help from China, but Europe hasn't come to the party.
No.
Japan hasn't been at that party in 40
in a while.
years. So it worked. In 20 or 30 years' time,
we might have a different view.
Yeah.
And I meant to touch on this, and then it slipped off the radar. So GDP numbers came out. Horrible.
The horror.
And doesn't bode well for the new dawn. We are really, as we've been speaking globally and so on and so forth, there's a lot happening. We cannot afford to not be growing, and a 3.2% contraction in GDP is shocking. How do we recover?
So it's a quick point in the new dawn.
And we're speaking about South Africa.
Yes, South Africa. So America was plus 3.2, we were minus. Although theirs got revised down and ours might get revised up. New dawn's plugging along. We saw it in President Ramaphosa's cabinet. That was his cabinet. He stamped his authority. Nobody believed me. I mean, he really did get his cabinet. But cabinet's a beautiful, wonderful thing, blah, blah, blah. But they're not on the ground. So there were three things that really hit that number. One, load shedding, no surprise. And that really, really hurts. And I think we forget just how much. Now, minus 3.2, everyone expected minus, no one expected that bad. Throw load shedding into an already stressed consumer and you get it. But the one that really came out at me was agriculture down 13.2. Now, agriculture is lumpy. Planting was a bit late this year because of concerns about late rains, and the Crop Estimate Committee has been pushing their crop estimates upwards ever so slowly over the last during the second quarter. So maybe that lumpiness has been a case of, well, simply planting was a bit late, so fertilizer purchases, etc. What I'm saying is we can expect probably agriculture to bounce back up. We saw certainly a bit of activity happening in restaurants and the like. But frankly, this is all trying to put spin onto what is a horror number and bigger pictures. We're going to be hard pressed to get 1% this year. And I remember, and I think was it Melissa Gagaba? It was one of our finance ministers, not last year, the year before. And he was talking about hitting 2.1% GDP by 2021, 2022. And my comment was, too little, too late. Well, maybe Mr. Gagaba is smarter than we all think. And I mean, 1%, 2% isn't enough for us. We're growing at 1%. Population growth is probably 1.5 or 2. South Africans are getting poorer, and we have been for a decade now. And it's not. The trick is, it's structural. Eskom. We can do. Eskom. Eskom is the problem. Is physically power plants, physically coal deliveries, physically distribution. Those sort of structural issues are the challenges that we have. And they're not going away anytime soon. And what I mean by anytime soon is we might have Didi Mabuza as our president before we start to see proper lights at the end of the tunnel, which aren't trains.
Or proper lights.
Actually, just proper,
just proper lights.
So as much as we expected negative, it was really, really bad. The second quarter won't be anywhere near as bad because we haven't had the load shedding and because I expect agriculture to bounce back. Well, it's almost over.
It's almost over, yeah.
But, is it going to be positive? Maybe. How positive?
Not very great.
Not a lot. And that's the trick. We can't get out of the rut we're in. And that's because when you're in these sort of economic ruts, you're trying to turn around an economy. And even if you've got the best people doing the turning part, it is hard, it is complex, it is slow, and it goes wrong.
And it's not up to us.
It goes wrong as often as it goes right. And to your point, it's not up to us, it's Eskom. And Eskom is decisions made a decade or a decade and a half ago, and they're coming home to roost.
Yeah.
All
right, Simon, thank you very much for a very informative session, once again.
Always a pleasure.
And I look forward to chatting to you in July, after I've been to Trump's state, and hopefully don't come back with measles.
Oh, measles. You've been vaccinated.
Yes, I have.
There we go. Enjoy it.